Morning, everyone, and welcome to What's Up Wednesday. Joining us today is Hadyn Little, the CEO of Foundation Fund Managers, and we'll be discussing a little bit about our market movements in South Africa and also what's going on abroad. We'll be looking at some of the rand-dollar movements in the markets and also try and give you some idea as to where to invest and how to invest strategically. So Hadyn, thank you very much for joining us this morning. How have you been keeping?
Yeah, Gary, good morning. Thanks for having me again. Good to see you as always, and especially good to see the sunshine outside our windows today. Jeepers, yesterday was miserable in KZN and probably most of the country. So yeah, just good to put that behind us and have a sunny day.
Fantastic. Well, I hope to complement our sunny weather we're having at the moment. We've got some sunny news for us, Saffers, as we look to do some investments with you. If we look back at the rand dollar charts, it's been crazy to see. We've been sitting around the 1539 mark as recently as like the 20th of August, which was just over 3 weeks ago. The rand has enjoyed significant growth since then, but when we spoke last, there was a bit of concern around the looming US jobs data. What's actually transpired?
Yeah, you know, it's in the currency market, it's quite a fast-paced market. There's always a next release that's bigger than the last one, and we quickly just digest what's happened and move to the next event. And most times, that's what's happening in the US market. And it was no different last week. We had just had, on the previous Friday, what's called the Jackson Hole Fed Symposium, where central bankers gather in the States. It was a virtual event this year thanks to COVID, but it's one of the main items on the calendar. That was the back end of August, 26th through the 28th of August. But as soon as that was out the way, then the market started focusing on the US jobs reports. The first Friday of every month, around about 2:30 p.m. our time, we get the number of new jobs created in the previous month in the US market. It's called the non-farm payrolls report. And June and July had really set the stage for expectations, because those 2 months, in each of the months, the new jobs created was around about 940,000 new jobs, so just short of 1 million new jobs per month. It was 934 and 938 in each of the months, respectively. Now, COVID Delta variant has had its role to play in markets and has slowed down economic recovery. So analysts were cognizant of that. The consensus call for the US jobs report for August was 720,000 new jobs, so a slight pullback from the 940s that we'd seen in the previous months. But the range of forecast was incredibly wide. It was something like 340,000 as the most pessimistic view and over 1 million as the most optimistic view. So either that means that economists really, or analysts, disagree with each other in their assessment, or most probably it means that people are just guessing and there's no real way of knowing what the number's going to be. But regardless, 340 to 1 million, quite a wide range, but 720 as the consensus call. As it turns out, the actual number was massively below what even the most pessimistic view was. It came in at 235,000 new jobs, which in an ordinary market pre-COVID would have been a blockbuster month. But in a post-COVID environment where they're trying to recoup 10 or 11 million unemployed Americans back into the job market, 235,000 is a decent number, but it's not really going to change the trajectory of their labor recovery. And quite simply, a massive miss to the downside is dollar negative, and the rand enjoyed it, and we moved on into further strength.
Sure. So the jobs report being a massive miss, does that mean that the Fed now is running out of time to formally announce their start of this asset purchasing program? What are their movements?
Yeah, you know, they are kind of being backed into a corner, but at the same time, we've got to be careful, because Jerome Powell, who's the head of the chair of the Federal Reserve, the American Central Bank, he's been very careful over the past 18 months during the pandemic crisis and now in the post-pandemic recovery to do what he says he's going to do. He wants to remain credible. He wants the market to believe him and to trust him. And so he's been cautious in his projections, but even though he's been cautious, he has been achieving what he set out to do. So Powell has been at pains to say over the last couple of months that the Fed fully intends to start the tapering of their asset purchase program in 2021. What that means is that every month right now, the Federal Reserve is buying $120 billion worth of bonds and mortgage-backed securities to maintain liquidity in the markets and make sure that the US recovery remains on track. $120 billion a month is a huge amount of money. And at some point, they're going to start trimming that down to 110, 100, 90. I don't know the increments. Maybe it's by $10 billion. Maybe it's by 20. Difficult decisions to make when you're spending in billions. But at the end of the day, he said 2021 is the liftoff for this tapering program, it's called. And we are running out of time. So the Fed has only got 3 more meetings this year, end of September, end of November, and mid-December. They can't announce tapering on the day. So Jerome Powell, I think, would really spook the market if he took to the podium and said, guys, we are announcing the start of our tapering process. It's going to be 20 billion off the table each month, and it's happening from today. He always is going to say it's going to happen from next month, just to give the market a bit of time to digest what's going on. That means the September meeting is pretty much off the table, because Powell and the team would want to see, what is September's jobs report going to be? What is it going to be? Is it going to be a rebound back into the 500,000 plus new jobs created in September, and therefore justify the start of their tapering program? But they're only going to get September's jobs data in the first week of October, which is after the September meeting. So more than likely, September is going to be a damp squib. There's going to be no real news coming out there. So then they'll get September's news in October, and they'll get October's news in early November, which sets up November as pretty much the only meeting left this year to announce the start of their tapering in 2021. Because if they say it's starting in December in the November meeting, that gives them the December runway that I've mentioned earlier. And I don't think that they'll say in December, we're starting in 2 days' time to try and make it before the cutoff of the year. If they don't announce in November, then December will be for January, February, March next year sometime.
Okay. So, I mean, obviously the Fed doesn't move the market in isolation, and there are other central banks that are now making waves. What's on the agenda in Europe? Is there anything else that you think the currency traders should be keeping their eye on?
Yeah, for sure. So the currency market and the Rand exchange rate in particular versus Rand dollar takes a huge amount of its price action from what's happening to the dollar, and by default, what are the Fed doing? But it's not the only central bank in the world. Of course, we've got in September, including our own central bank, or the Monetary Policy Committee, or MPC as it's known, announcing our own initiative. And are we going to be tightening interest rates, or by tightening, lifting interest rates in South Africa? I don't think so. I think our consumer price index is around the midpoint of the MPC's target. That's 3% at the low end to 6% as a top end. And I stand to be corrected, but I think we're around 4.4% at the moment. So no real need for our local interest rates to increase. But at the same time, we've got emerging markets, central banks all coming to the table. We've got the Canadian Central Bank expected to announce an increase in their interest rates early next year. But these peripheral central banks don't really move the market. It's really the Fed, the Bank of England, the European Central Bank, and maybe the Bank of Japan, or the Japanese Central Bank, whatever they're called, that the market really focuses on. And tomorrow we've got the ECB, the European Central Bank, announcing their latest monetary policy announcement. There's always a bit of speculation as to what's going to be said, and I think we should always err on the side of caution. Central bankers, by default, are not the most risk-taking, flamboyant people out there, and they themselves err on the side of caution. But the European Union, or Eurozone as it's known, their inflation rate has steadily ticked up over the last while, thanks to supply bottlenecks and supply shortages and stimulus measures. And at 3% CPI, consumer inflation, that 3% is now at a 10-year high in the Eurozone. Sitting at a 10-year high, that means that there's now increasing calls from members in the ECB to start talking about, if not even announcing, the start of their own tapering program. They at the moment are spending 80 billion euros a month on asset purchases, And there's talk in the town of that coming down to 60 billion in the near future. And of course, your tapering program is the first stage of policy tightening. Once that's done and you're down to zero, you then are able to start increasing interest rates, which is always positive for the currency that we're talking about. So if the ECB get a march on the Fed, then maybe that signals higher interest rates in the EU down the line, and it's euro positive. So we'll wait to see what happens. But in terms of non-central bank items that the market definitely has to keep an eye on, COVID Delta variant, quite simple. It's now been dubbed the pandemic of the unvaccinated, and there's a large amount of truth in that. The only problem about that is that there are a lot of unvaccinated people, both in the developed world as well as emerging markets. In the States, I saw a stat yesterday that they've got the past 2 weeks in terms of hospitalizations thanks to COVID and the Delta variant is up 66% from the previous 2 weeks. So they're putting on big numbers, and it's the same around the world. The higher the Delta variant numbers go, the bigger impact that's going to have on economic activity, and that's going to spook the market, create a risk-off environment. And in a risk-off environment, the dollar always does well as a safe haven asset. So yeah, that unfortunately is perhaps a negative for the rand as well.
Yeah. And then just to end off with a little bit of market news from this morning that you circulated around some better than expected South African markets news, which is encouraging for South Africa. Do you want to maybe just highlight a little bit about that?
Absolutely. You know, so July with alert level 3 lockdowns, or maybe even stricter than that. I think it was actually 4 at one point. With the unrest in KZN and parts of Gauteng, which we all know about, and with a massive cyber attack that hit our ports and transport authorities, which impacted economic activity, there's been quite a sort of doom and gloom mood about town. And especially, or definitely when I speak to my clients, there's a couple of heads hanging low, and it's understandable. But you know, yesterday we got a data release for our Q2 GDP print for South Africa, that being March, April, May. January, February, March, April, May, June. There we go. I got it right, I think.
Yeah, Q2.
And that was pre unrest, pre-lockdowns. And the figures were supposed to come in strong. It was forecast to be a 2% annualized GDP growth for the quarter, down from the previous month of 4.5%, I think it was. Previous quarter, but still in expansionary territory. And in fact, we smashed the forecast. The Q2 of 2021 came in at 4.7% annualized growth.
Yeah.
And that is good news for SA. I mean, we just need to expand as quickly as we can, not only to recover our pandemic losses, but also to chip away at our ridiculously high unemployment rate. And it's well documented that if we settle back down to the 1.5% to 1% GDP growth per annum that we were stuck in pre-COVID, we know we're near going to eat into unemployment. So we need to capitalize on this momentum and hopefully grow in terms of infrastructure projects. And there's a lot of stuff that the government's trying to push through to tackle unemployment and at the same time promote economic growth. So yeah, that's a rand positive. Ordinarily, we would have done well yesterday with that news. Unfortunately, there was dollar strength on the same day and we got hit back. But yeah, good nonetheless.
No, that's fantastic, Hadyn. Hadyn, yeah, thank you so much for that update. I really hope that we can capitalize and make things happen. I think there's lots and lots and lots of opportunity that's just hanging around waiting for something to ignite it. So yeah, we keep our heads down and keep trudging on. Is there anything else that you'd like to add in closing, Hadyn?
Nothing really, other than the fact that our market is always, a function of local activity. And when I say our market, I'm talking about the JSE, our listed stocks. And we also take a lot of our lead from what's happening internationally. I was watching an article on Bloomberg yesterday where the guys were talking about how the US market has set or closed at 54 record highs in 2021 so far. The last 10% correction in the US market was in October last year. So it's a long time ago. We're supposed to get 4 or 5 of these things in a 12-month cycle. And I think most interestingly, what they pointed out was that the S&P 500 has only gone through a calendar year with no 10% correction twice. 1995 and 2017. I wasn't in the market in 1995, but we were investing in 2017, and I remember it quite clearly. There were 13 months of consecutive gains. It was crazy. And we're getting close to setting or those sorts of levels again now, which means one of two things. We're going to set a new record in 2021 for a number of days closed in record territory, or more probably, there's a correction in our imminent future, i.e. the US market's going to have a 10% or worse pullback, which is a healthy part of a functioning market. We shouldn't be scared of it. It actually needs to happen to flush out speculation. But if they take a downward dip, you can bet your bottom dollar, so will we. So if it hits, no need to panic. It needs to happen, and we keep going from there.
Yeah. I often say to people, I use the analogy of surfing. When you talk to investors, a lot of guys are waiting for the dip before they buy and before they invest. And I always use the analogy of surfing, where you've got two ways to catch waves. You can either sit on the beach and wait for the sets to come in. When they come in, you quickly put your wetsuit on, run down the beach, get into the water, paddle out to backline, and try and catch one or two of the waves. Or you can be out at backline waiting for the sets to come in. And when they come in, you're there, the waves are there, and you can start catching them and taking more opportunity. And I think one of the big messages that I'd like to drive is for any investor who has a strategy, be it local, international, or a blend of both, is don't sit passively waiting for opportunity to arise with money sitting in a bank account. If you've got money that you would like to invest and have a strategy, have it ready for the market. So the movement, as soon as it happens, you are there to be able to capitalize on it. So as an example, if you wanted to invest offshore and you're looking for a dollar-based type investment, rather convert your rand into your dollar and let your dollars sit waiting for markets to move, and then you're poised to take advantage of that. And I know that you guys have been chatting quite a bit about it, saying that you have got lots and lots of currency sitting waiting for this market movement. So for investors out there, if you don't have your money invested yet, I strongly suggest making sure it's readily available for the markets when they do make this correction, if it comes, so you can take advantage of the upside.
You're exactly right. So, we as asset managers, first and foremost, and we focus at the moment primarily in the offshore market, we haven't stopped pooling cash in our client portfolios, waiting for the correction to come along. And right now we're sitting at close to $4 million in cash across my client portfolios. That's 58 million rand. It's not a small amount of money sitting idle on the sideline, presumably from a client's perspective. But being in cash is a decision. We're waiting for that 10% or bigger correction, because when it comes, the cash is there, ready to be invested. I don't need to phone clients when the correction hits to say, it's here, quickly deposit your money, and then there's a problem and it doesn't get there in time. It's ready and waiting. So it talks perfectly to your analogy.
Yeah.
The correction will hit. We will be ready to invest, and we will enjoy the upside post-correction. So yeah, make sure that there's as few hurdles or obstacles between yourself and the opportunity while we wait for the correction to arrive. And we don't really care what the catalyst is going to be. It'll be something. It always is something. And it doesn't really matter. The market reaction is the same, and that's what we wait for.
No, that's fantastic. Hadyn, thank you so much for this morning. It was lovely catching up with you. And we'll chat to you next week, Wednesday, and hopefully have some more interesting information. Thank you so much for your time. I really appreciate it.